You're listening to Sound Money from Casey Research.
Hello and welcome to the Sound Money Show from Casey Research with me, your host, Andy Duncan. My guest today is Terry Coxon, Senior Economist at Casey Research. Today we'll be talking about how to spot a looming crash, global economic trends, and how to take account of political risk. Hello, Terry.
Hello, Andy.
Now, at the recent confirmation of Janet Yellen as the new chair at the Federal Reserve, she was smiling broader than a Cheshire cat. Do you think she was right to be smiling, or should she be extremely nervous instead of the control she's about to have over the global economy?
Well, taking on a position such as has been handed to her may seem like a dream come true for a career government employee. But she may find that she presides over a disaster. She is inheriting all the problems in the economy that the government has been dodging for the last 15 years.
And what do you think are the most kind of powerful economic trends driving the global economy at the start of 2014?
Well, the most powerful trend driving the global economy is the use of the printing press to create more money and more money and more money. And all that free money has the effect of buying off the problems from the past and avoiding dealing with the problems. And so they just accumulate and make the economy more and more fragile.
Now, the Fed seems to have got away, at least temporarily, with printing trillions of dollars over the last few years without seeing price inflation get out of control. Now, that money has to come out of excess reserves eventually. When do you think that's going to be?
Well, there are really two elements to it. One is the money supply that is in the hands of the public. And that has grown about 80% since the financial meltdown in 2008. And it is something of a puzzle why that 80% increase in the M1 money supply has not led to rapid price inflation. I suspect the explanation is that people are still cautious about spending after going through the very fearful time in 2008 and 2009. And on the business side, it's only as the economy further recovers that you'll see more spending for business investment. Now that's the story on the public's money supply. There's a separate story that you touched on, which is the excess reserves held by commercial banks on deposit with the Federal Reserve. That is a brand new kind of problem, almost invented by the Federal Reserve in 2009 when they started paying interest on the deposits that commercial banks hold at Federal Reserve banks. Now, the total amount of excess reserves right now is close to $2 trillion. And to keep that $2 trillion kind of isolated or corralled or sequestered, the Federal Reserve pays interest to the commercial banks who own it. They pay it, right now, the rate is 0.25%, which, because short-term rates are so very low, is an attractive return for a commercial bank. But as the economy recovers and short-term interest rates start rising, then to keep that $2 trillion sequestered so that it does not turn into a giant inflation bomb, the Federal Reserve will have to pay a higher and higher rate of interest to the commercial banks that own it. Somewhere around 4.5%, the Federal Reserve will reach the point where it is spending all of its income from its giant investment portfolio to pay interest to commercial banks. And when interest rates go above that level, they will be in the bizarre position of being an institution that has the power to print money at no cost and still is operating at a loss.
So, do you think that that is going to happen then? If you read something like classical Austrian business cycle theory, we're heading towards hyperinflation when that event occurs. But if the central bankers do actually kind of have a bit of sense going into their heads, they might stop printing, and that might bring on a hyperdepression as 15 years of malinvestments are revealed. Which way do you think it's going to go? Do you think we're going to hit hyperinflation? Do you think we're going to hit hyperdepression? Or is there some magic nirvana where the central banks can actually print the exact right amount of money?
Well, I think the short answer is both. For the foreseeable future, the Federal Reserve will oscillate between worries over a depression and worries over runaway inflation. So I expect to see both of those things occur in sequence, and they may occur more than once. There is just no graceful exit from the current situation. What makes it impossible to exit the situation without some serious pain is the history of papering over problems for the last 15 years.
And how do you think our listeners will be able to spot the kind of upwelling or the kind of problem about to realize itself? How will our listeners know when to do something?
Well, you're asking for an awful lot. When you talk about a crash, you necessarily are talking about a surprise, and there's no way to eliminate the element of surprise or to get ahead of the element of surprise. The Federal Reserve can keep the game going for a long time, but we don't know the point at which it might get serious about winding down the expansion in the money supply. We're currently in a so-called taper, and what I think will happen is that the Federal Reserve will taper more and more, and will keep tapering until it produces a collapse in the stock market. But no one knows where that point lies. The best you can do is to see that the market is very fragile and that it's likely headed for a big drop, and not make investments that expose you to that risk.
And if we can't tell when something's going to happen, and we don't know whether it's going to be the kind of depression or the hyperinflation, what do you think our sort of listeners should do then to protect themselves from either kind of situation?
Well, there's an initial psychological step, and that is to throw away the notion that you need a certain rate of return and that you have to go do whatever it takes to get that rate of return. It may be that the rate of return you have in mind for your portfolio is simply not possible. So you need to look for the best that is possible. If you are a risk-averse investor, then the two primary assets for you are precious metals and cash, because you're already in a period in which conventional investments are going to be highly volatile. There will be periods when the fear of inflation is the dominant sentiment, and that will mean rapidly rising prices for gold. There will be periods when people will say, what were we so worried about? And in that case, gold will be doing poorly, stocks will be doing well. If you are well armed with cash and gold, then you can take advantage of the buying opportunities that are going to show up.
Now, a couple of other risks which have arisen in the last few years, as well as inflation risk and deflation risk, are political risk and regulatory risk. How do you let political risk affect your particular investment strategies?
Well, the political risk doesn't really bear much on the choices of investments. It isn't as though there's a pro-inflation party in Washington or a pro-depression party in Washington. It's more like the political contest is more like a wrestling match for control of a vehicle that none of the contestants really knows how to drive.
And do you think we need to actually fear political risk over the next few years?
I don't think of it as a risk. I think of the political environment as just something bad that you have to live with. Risk implies uncertainty, and in the case of the government, there is no uncertainty. We know it's going to be foolish. We know it's going to be reckless. We know it's going to be very expensive. We know it's going to be meddlesome.
And do exactly the opposite of the right thing to do. Now, it's been great talking to you today, Terry. Where's the best place for our listeners to read more of your kind of economics research?
Well, I write an article every month for the Casey Report. And in the upcoming issue, you'll see an article I've written on the topic of the manipulation of the gold market and how an investor could profit if he determined that the gold market, in fact, was being manipulated.
Okay, I look forward to reading that. Thank you very much for your time today, Terry Coxon.
Thank you, Andy.
Subscribe to Sound Money Radio on iTunes. You can also visit us at caseyresearch.com/sound-money, where you can subscribe to our mailing list and listen to all of our podcasts. If you enjoyed the show and learned something new today, please tell all your friends all about us to help us grow this podcast. I'd like to thank Terry Coxon of Casey Research for joining us on today's program, and I'd like to thank you too for listening. Until next time, goodbye.